After 11 increases by the Federal Reserve Board taking interest rates to their highest level in 2 years, I think many investors are becoming seduced by these higher rates. 5.25% on money market funds and treasury bills and CDs. But we think that investors may be missing an opportunity. Look, there are certainly valid reasons as to why one might hold some cash. I hold cash to cover emergency purposes. I might hold cash because I have short-term obligations that need to be met, and I want to avoid market risk in that equation. Maybe I hold cash for tactical reasons. So the point of the matter is not necessarily should an investor hold cash, but are they overweight cash, and in doing so, missing opportunities? Here are the objections that they sometimes raise. John, I don't want to take risk with my money. After all, if I put money into a treasury bill or a CD, I'm not subject to any interest rate risk. I'm not subject to any credit risk. I know I'm going to get my money back at the end of the day. But there are two maybe unintended risks or consequences that investors are facing using that approach. Number one is inflation risk. Cash has proven to be an ineffective vehicle to grow our capital. Why is it we go to work every day? Why is it that we forgo current consumption for the benefit of longer-term saving? We do this to improve our purchasing power and to provide us with resources in the future. Cash hasn't done a very good job of meeting that objective. The second problem in holding too much cash is that it doesn't act as a buffer against equity market volatility. Longer duration fixed income assets provide not only a higher current cash flow, but they also provide you with the opportunity to produce capital gains that might offset temporary drawdowns in the equity markets. There are a number of educational tools that advisors can use in starting this conversation with clients who are reluctant. John, why would I do anything else with my money? I'm getting 5.25% without even trying. You're going to need to convince me that it makes sense for me to do something else with my capital other than to take today's higher long-term rates. Number one, the first thing that we want to remind clients of is that cash generally, compared to other asset classes, underperforms. Look, I understand volatility in both equities and fixed income, but it's important that clients understand that volatility is the price that we pay for the opportunity to earn higher returns. One doesn't come without the other. I want to lower my volatility, I've got to accept a lower return. I want to increase my rate of return, then I've got to accept greater volatility. But it's important that clients understand what volatility really means to them. We use a term like standard deviation when we advise clients and present them with information regarding their investment choices, but clients don't really define risk as standard deviation. The typical client generally defines risk as losing money, right? I invest a certain amount of capital in a particular investment. I look at my statement a month or three later and it's worth a little bit less. That's not really, though, the risk that investors should be focusing on. I think the most important risk that investors need to focus on, with the help of their advisor, is the risk or the probability of achieving their personal financial goals. If I want to send my kid to TCU, if I want to buy a second home in Highland Park, Illinois, if I want to retire 10 years from now and donate my time and my wealth to certain charities, those are the goals that are most important to me, and not achieving them is the risk that is maybe most prevalent in my personal life. Educating clients about the longer-term opportunities in financial markets. Look, volatility is always going to be present. I look at equities over a one-year period of time. I may be up 50% in 1 year. I may be down 30 in the next. But that's a one-year holding pattern. As I begin to extend time horizon from 1 year to 5 years to 10 years to 20 years, the probabilities of negative experiences diminish or are reduced as I extend my holding period. So let's make sure that clients are aligning their specific investment plans with their personal time horizons. Keeping money invested for 6 months in an attractive CD doesn't get me to where I need to be. Step in the process is really understanding the perspective of the client. Clients overweight cash hypothetically, they've got 30%, may not necessarily fit their needs. I want to understand why. What is the rationale behind your propensity to overweight cash? Is it reluctance because you're concerned about market volatility? Is it because you have a short-term horizon? Is it because you're just confused as to what opportunities might be most suitable for you given your circumstances and your financial resources? Asking the right questions, I think, goes a long way in developing a strategy going forward. What do you plan to do when your 6-month CD matures? What has held you back from making a longer-term, maybe more productive investment vehicle? Or what are your plans for this capital? Is it going to be used on a short-term or a longer-term basis? Those kinds of questions can be really helpful in understanding the client's perspective and beginning to move forward with an effective strategy. I also think there are a variety of ways to get our clients moving in the right direction. Maybe it's not a commitment of 100% of their capital today, but maybe if we're overweight cash today, maybe it's staging 10% in over each of the next 4 quarters. Maybe it's the opportunity to build ladders that provide me maybe with the best of both worlds. Greater returns on the long end of the ladder, but shorter-term liquidity to provide me with the resources that I might need on a shorter-term basis. Vehicles like this or approaches like this can often be helpful in that regard.